Hello, welcome back to Analysing Financial Statements. In this segment, we're going to go into a bit more detail on the cash flow statement and how to analyse that for the business owner. Now, previously we looked at analysing and communicating this information in terms of an income statement and balance sheet, and analysing that for the business owner or the director. Now, just a brief recap. Accounting's about identifying a financial transaction, measuring it, recording it, and then communicating it. So what do we communicate to the business owner or the director? Well, we communicate a story of the business. So the income statement and balance sheet are two of the most important statements in a financial report. Need to be communicated directly to the management or to the owner or the director of the business. It tells a story of the business, how it's performing, and it tells a story of the position of the business. However, there's some other statements that need to be communicated to the owner. And this one statement is called the Statement of Changes in Equity. Now, this section just comprises the equity section of the balance sheet. So the equity section of the balance sheet would have share capital, what was contributed initially when the company was established, and any additional capital contributed by the shareholders. And the other component in the Statement of Changes in Equity is retained earnings. So this retained earnings represents all profits, all losses from when the business commenced as an accumulation. And the other component of a Statement of Changes in Equity is reserves. So any cash or capital reserves are in the equity section, and that does appear in the Statement of Changes in Equity. And any movements in reserves need to be captured during the financial year so that the business owner or the director knows what movements there are in the equity section. Now, perhaps also one of the most important statements in a balance sheet, in a financial report that's often missed is the statement of cash flows, or otherwise known as the cash flow statement. Now, why is that very important? Well, it's important because it tells you a picture or a story of the movements of the cash balance of the business. So I'm going to share my screen. So hopefully you can all see this. This is XYZ Pty Ltd. So from the first segment of Analysing Financial Statements, we showed the director of the business. Now, I'm mainly doing this for small to medium-sized businesses where the director would most likely be the owner and a shareholder of the business. Or if there's a spouse, the director and their spouse would be the owners and the shareholders of the business. So this is XYZ Proprietary Limited. We showed a income statement and analysed it for the director. And we've said to the director, well, there was a loss in 2019, but somehow the business has turned that around and made a profit in 2020. And that profit resulted in came from increases in sales or trading income and a reduction in the major expense categories. Now, going over to the balance sheet, or known as a Statement of Financial Position in its proper term, we see the current assets, non-current assets, current liabilities, non-current liabilities, and equity. So we have told the business owner that, yes, your assets as a overall are reduced, but at the same time, your liabilities overall reduced. So the business has improved in this sense. And last time we discussed the percentages of movements from year to year. That's one way that you can analyze a set of financial statements, an income statement and a balance sheet. You can look at the difference in terms of the amount in comparison to a prior year and the percentage difference. Now we look at the cash flow statement, which is one of the most important aspects of a business's financial position. So on the right side, we have a statement of cash flows. Now that's general. I would say in most instances where the business is a small business and it's not a reporting entity, we don't provide a statement of cash flows. However, for a large business or a business that is a reporting entity where a set of audited accounts is required, then a statement of cash flows will be required. Now, there's two different ways in preparing a statement of cash flows. One is the direct method, where we have cash flows from operating activities, and then you itemize them. So receipts from customers, payments to suppliers and employees, increase or decrease in provisions, increase or decrease in receivables and payables, interest income, and so on. And then you come to a net cash flow from operating activities. Now, this direct method, it's not widely used these days, but it is an allowable method under the accounting standards. However, if a company chooses to use the direct method to report the statement of cash flows, the standard tells them that you need to disclose in the notes to the financial statements a reconciliation between the net profit in the income statement and the cash flows from operating activities. Now, that's an indirect method, which is more commonly used. However, just quickly, the components of the cash flow statement. So whether you're using the direct method or the indirect method, you have cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Now, I'll discuss what goes in where shortly. Then you come up with a net cash inflow or outflow for the year. And then you have a cash at the beginning of the year and then cash at the end of the year. Now, when using the direct method, you itemize each line in the cash flows from operating activities, and you need to do the note as a reconciliation between profit and cash flows from operations. Now, the more common method is the indirect method, and that's probably what you're taught at universities or in your degrees or diplomas. You're taught the indirect method, where you start off with the net profit in the income statement. Now, whether you start off with a net profit before tax or before depreciation, all these sort of things, it does not matter. There's no prescribed way in how to do this, but we recommend the net profit after tax. So the net profit in this case, for example, is $40,000. In the income statement of XYZ. So we start off net profit, $40,000. Then we add back the depreciation and any amortization expenses if applicable. So from the income statement, the depreciation expense is $30,000. So we have a net profit 40, add back depreciation 30,000. So the real profit of the company is $70,000. Then you come to the cash flows from operating activities. Now, this operating activities, think of it as basically the daily operations of the business within a 12-month period. So in cash flows from operating activities, we are concerned with current assets movements, with the exception of cash, and current liabilities movements, increases or decreases. Now, there's a good way to remember this. How do you determine whether an increase in a current asset or a current liability is a positive or negative figure? And how do you determine whether a decrease in a current asset or current liability is a negative figure? How do you determine these things? Well, it's quite simple. So an increase in a current asset may be a good thing from a balance sheet perspective. So, for example, an increase in inventory or an increase in debtors, well, it may be a good thing from a balance sheet perspective. However, from a cash flow perspective, well, it may not seem to be a good thing, because an increase in an inventory, for example, it means that you may have paid cash for purchasing stock. An increase in receivables or trade debtors may mean that you are selling more items on credit, or that you're giving your customers more time for them to pay off their accounts. So it may not seem to be a good thing in terms of cash flow. A decrease, so an increase in current assets would have to have a negative amount shown in there, which, when you look at the proper set of statement of cash flows, you'll see these negative amounts in brackets. So that means cash outflows. Now, on the other hand, a decrease in current assets on a balance sheet perspective may not be a very good thing, because your current assets are reducing. However, from a cash flow perspective, it may be seen to be a good thing, because if your inventory is decreasing, it may be that you're selling off stock very quickly. If your trade debtors are decreasing, it may be seen that you're receiving cash from your customers a lot quicker, and that you're receiving them timely. So a decrease in a current asset, so receivables, prepayments, stock, is represented by a positive amount, which means your cash flows from operating activities increases. Now we come to the current liabilities section. Now that's completely the opposite of the current assets. An increase in a current liability, so for example, payables and ATO payables and employee benefits, may not be a very good thing from a balance sheet perspective, because your current obligations are increasing. However, from a cash flow perspective, that provides you with a greater cash flow, and it means that you don't have to pay out that obligation very quickly. So from a cash flow perspective, it may seem to be a good thing. So an increase in a current liability is represented by a positive figure. So a positive figure always increases your cash flow from operating activities. A decrease in a current liability, where on a balance sheet perspective may seem to be a good thing. The company's paying off its obligations quicker and in a more timely manner. However, from a cash flow perspective, a decrease in a current liability may not seem to be a good thing, because you're using cash to pay off your payables, your trade creditors, your ATO payables, your employee benefits, and so on. You're using cash to pay these things, and so it reduces your cash flow. So a decrease in a current liability is accompanied by a negative amount. And again, that negative amount would be shown in brackets as a cash outflow. So once you determine all of these increases and decreases, after taking into account your net profit and adding back depreciation, you come up with a net cash flow from operating activities. Now, whether you're using the direct method or indirect method for preparing a statement of cash flows, the net cash flow from operating activities should be the same as what you have, whether you're using either method. So that's your operating activities. So in this case, XYZ Proprietary Limited, if we have a look at their current assets, the receivables reduced by $20,000, prepayments reduced by $5,000. So that means basically you've received money from your receivables and you've got more cash flow. So in total, we have a decrease in receivables and prepayments of $25,000. So that $25,000 is a positive figure because there's more cash flow coming in. And then the other current asset is inventory or stock. So like in 2019, it was $65,000. And now in 2020, it's $25,000. So there's a decrease of $40,000, which means you may have sold stock or some stock may have been written off. But in this case, let's assume we sold stock and therefore it reduced by $40,000. So that means a decrease in stock is a good thing from a cash flow perspective because you've gotten cash from selling stock. Now we come to the current liabilities. So we have a decrease in payables. We also have a decrease in ATO payables, and we also have a decrease in employee benefits. So all in all, we have a total decrease in payables of $21,500 if we also take into account the income tax provision. So a decrease in a current liability is represented by a negative amount, which means it's a minus $21,500. So when we add all of these figures, the net profit, add back the depreciation, and then add and subtract all your changes in cash flows from operating activities, you then have a net cash flow from operating activities of $113,500. Now we come to the cash flows from investing activities. Now, investing activities relates to any non-current assets that the business purchases and uses over a long-term period, more than 12 months, and that asset in turn will generate income for the business. So investing activities deals with any proceeds from sale of plant and equipment or motor vehicles, and also any cash flows or purchases, cash outflows from purchasing property, plant and equipment. Now, note that we have a zero balance here, even though there's a reduction in the non-current assets in plant and equipment and motor vehicles. That reduction is due to the depreciation. Now, we've added back the depreciation in using the indirect method. So therefore, we don't need to account for the change in the non-current assets, only if it's resulting from the depreciation expense. If there's a sale of a non-current asset or if there's a purchase of a non-current asset, it's included in the cash flows from investing activities. So investing activities is all about non-current assets. Now we come to the third component of the cash flow statement, which is the cash flows from financing activities. Now, in terms of financing activities, you want to show the business how the assets are financed. So the assets may be financed by debt or by equity. So debt means obviously whether there's a bank loan or whether there's whether the director or the owner of the business, as the director, contributed money into the business and then in turn the business purchased these non-current assets. So cash outflow, so proceeds from long-term borrowings. So any loans issued by the bank or any loans issued by the director or any funds issued by the shareholder in terms of share capital is a positive amount, which means that there's more cash flow coming into the business. So any proceeds from shares issued and borrowings and so on is represented by a positive amount, Whereas any loan repayments, so repayments to the bank or repayments to the director for a director's loan, or any payments of dividends is a cash outflow. So it's represented by a negative figure. And so we see that there's been some repayments of non-current liabilities. So there's a loan repayments and there's a director's loan repayments, a total of $103,500. So that's a negative amount, which reduces your cash flow. So now the interesting thing is in terms of the interest components. So interest income or interest expenses, a lot of businesses and clients ask you, well, where does the interest go? Does it go into cash flows from operating activities or is it financing activities? Now, there's no set prescribed method in the accounting standards telling you that you must have interest classified in operating or financing activities. However, most companies tend to classify interest paid or interest received, regardless of whether you're paying the interest to the director or to the bank or shareholders or whatever the case is. Most companies classify the interest component as a cash flows from operating activities because interest is considered as part of the company's operations, and it's payable. It's paid each month or whatever the interest policy is of the lender. So most companies would classify interest paid and received in its operating activities. But it doesn't really matter. There's no legal prescription as to where you need to put that interest component. Now, when we've determined all of the cash flows from operating, investing, and financing activities, we come to the net cash inflow and outflow. So we add the net cash flows from operating activities, net cash flows from investing activities, and net cash flows from financing activities. In this case, for XYZ Proprietary Limited, the net cash inflow or outflow is a positive amount of $10,000. So we tell the director or the owner of the business that of all of these movements in the balance sheet has resulted in a net cash inflow for the whole year of $10,000. Now we take the cash at the beginning of the financial year, which is $5,000 in 2019. So we add the cash at the beginning of the financial year, and then you come to the cash at the end of the year of $15,000, which should then reconcile with your cash amount for the year ended 30th of June 2020. If all your calculations are correct, you should arrive at the same figure. So that's basically the statement of cash flows. It tells the business and also the business owner how you moved from $5,000 in 2019 to $15,000 in 2020. So having mentioned all of these things, wouldn't the business owner like to know how the business got from $5,000 cash to $15,000 cash at the end of the year? I would say yes, the business owner would want to know how that movement in the cash happened, and how you explain that movement to them is by preparing the statement of cash flows. Now, next segment, we'll be looking at ratio analysis, which is another way of analyzing financial statements. So stay tuned for the next segment, but I trust in this segment you have a more clearer understanding of how the business's cash flow operates and what we tell the business owner in terms of the balance sheet movements and the cash movements. Now, please bear in mind, this is not a substitute for any financial advice. I do not provide financial advice online. However, if you do need to come in and talk about your position, the position of your own business, feel free to contact me and I'll be happy to make an appointment with you in the office. But stay tuned for our next segment where we'll discuss ratio analysis in a little bit of depth.